Welcome to our May Lunch and Learn for CRW, the current state of local commercial real estate financing. Today's program, as are all of our Lunch and Learns, are sponsored by Landmark Credit Union. They're a tremendous partner, not only this year, but for several years in the past. And we have one of our speakers here from Landmark today. I know Adam is very busy with lots of expansions throughout southeastern Wisconsin. Today's program will run noon to 1 p.m. We'll have about 15 to 20 minutes for question and answer after our panelists speak. Our Lunch and Learns highlight member companies and a variety of issues and deals. If you have any ideas, please let me know and we can get them featured in one of our monthly Lunch and Learns. So everyone on today's call is muted, but you still can participate. So send us a chat in the chat function or through the question and answer box, and we will make sure that your question is answered in the 20 minutes at the end of the discussion. Again, big thanks to Landmark Credit Union, our presenting sponsor for the Lunch and Learn series. And also take a look at our 2021 CRW annual sponsors. Without these sponsors, our industry doesn't go. So please recognize our annual sponsors for the support that they give to our industry and to our organization. And please choose to do business with these folks. Some of our upcoming events, you can find out more at crw.com. This Wednesday, I'm very excited about our 1 year later, 10 years beyond event. We have a futurist coming and a local reaction panel. This is going to be a hybrid event. We're going to see how this goes. We've got about 100 people who will be in the room. It is a huge room, so there will be plenty of social distancing. And then we've also got virtual attendees participating as well. So you can still register. There's a 15% off code or $15 off code that you can grab by contacting either Amanda or myself. Building tour spotlight. We are going to be heading down to Chicago on May 20th. So please consider joining us. We're probably going to have to take the day off, but it's well worth it. Then we'll be visiting Paul Davis Restoration and Brian, who'll be taking us through their brand new facility. And then mark your calendar for the CCIMS IOR golf outing. That's going to be one of the first of the season. And then also our much anticipated golf league begins on June 15th. And then of course, the CRW golf outing on August 16th, and that's going to be at the River Club of Mequon. So our panelists today, and I know we'll go through introductions. We're really grateful to have all of them with us. We have some fabulous experts within our midst, within our ranks, within our organization, and they're going to share with us today. I'm just going to start and introduce our moderator, Steve Mcguire. He is with US Bank, has been a fantastic partner on our programs committee and a great leader for our organization and our industry. He is going to take us through today's program for about 40 minutes, and then we'll have 20 minutes for question and answer. So take it away, Steve.
Great, thanks, Tracy, and welcome, fellow CAR members. I think as we all know, real estate's a very, very leverage-dependent business. And what impacts the lenders and their appetite for making loans, their appetite for structuring deals, pricing spreads, has a big impact on development activity. It's a big impact on property values, ripples through all of our lives. So we're really pleased to have a great panel today where we can talk about what happened when COVID hit. You know, what happened, where are we today, how far out of the woods are we, where are we headed, will it ever be normal again? Our panel includes leaders from a regional bank, from a money center bank, from a credit union. So we kind of got three different perspectives on how people address the COVID issue and where they're going from here. And so it's Regenia Levchets from First Midwest Bank, John Mulchahy from BMO, and Adam Newman from Landmark Credit Union. So to begin, with no further ado, let each panel member introduce themselves and tell a little bit about their company to begin us. So Regenia, why don't you start?
Sure. Hi, everyone. So my name is Regenia. I am with First Midwest Bank. I have been generally in real estate since 2007. Great timing there on my part, but started at M&I and have basically been in commercial real estate in Milwaukee since then. I joined First Midwest in February of 2019. We are a Chicago-based bank. about $25 billion in size. And most recently here, last summer, we closed on the acquisition of Park Bank. So we have now a whole team. We do obviously real estate, but also C&I, business banking, sort of everything you would expect from a regional bank. So for real estate, we focus on deals, you know, as small as it can be, up to about 25 to 30 million in deal size.
Great. Thanks, Regina. And John, why don't you tell us about yourself and BMO?
Yeah, happy to. Hey, Steve. Hey, everyone. Name is John Mulchahy. I'm with BMO Harris Bank. I've been with the bank about 15 years in a whole bunch of different roles. Most recently, I focused maybe 4 years ago on growing our Texas office and institutional clients in Texas, and then last year took on Wisconsin as well, where I've lived most of my life. So happy to be on today. I don't think I've shared this with Tracy even, but my career started as an intern at CRW back in undergrad. So coming full circle as part of this panel today, which is great. But a few notes on BMO. We're a top 10 bank in North America, headquartered in Toronto in the BMO Financial Group, but then the BMO Harris Bank U.S. affiliates headquartered in Chicago, and spend quite a bit of time down there. So
Great.
That's it.
Thanks, John. Adam, I know you have been the driving force at Landmark. Has been a tremendous growth over the last few years in the real estate industry. So give us a little background on yourself and Landmark.
Well, thank you very much. I've been at Landmark about 9 years, and before that spent about 16 years with a regional bank, larger regional bank. Landmark has had a lot of fun, I would say, over the last 9 years. We really focus on multifamily, retail, industrial, basically all forms of commercial real estate. Deal sizes are anywhere all the way down to 50,000, but our core is really that 500,000 up to about 10 million per property. And we've been getting more shots at the larger deals, which is very nice, but we really like that core. Feel like that's the essence of Wisconsin, if you will. Landmark is the third largest financial based in Wisconsin and the largest credit union. And we are a state chartered credit union, so we're very focused on Wisconsin and I think Lake and McHenry counties in Illinois as well.
Great. Why don't we start with you since we have you on there? When COVID hit, how did Landmark address it initially? Did you leave the market at all? Did you stop making loans for a while, jump back in? Did you never leave the market? Tell us in general terms how COVID impacted you guys last year.
Sure. You know, our primary focus was not to leave the market at all. It was to make sure that we were sensitizing the data to make sure that we were making the right credit decisions. So there was definitely a drop off in activity from mid-March through June. Quite a few deals fell apart. But what we did was just say, listen, we still are monitoring the Wisconsin activity. We didn't see a significant increase in vacancies across multifamily, certainly some in the retail sector, but a lot of the retail we do is new construction. Same on most other commercial real estate types. So there was a lull. We did add some new sensitivity, increase the vacancy factor when we were looking at new deals. But in the end, we ended up having the best year we've ever had, about a 20% increase over 2019.
That's amazing. Can you share how kind of volume you guys did last year? Is that something you can share with us?
Sure. With 7 lenders, we did $209 million in new dollars last year. We also did about $243 million in modifications and rewrites. So
take any properties back?
No, in fact, we didn't put a single property on the watch list due to COVID. So I think that's an amazing thing about Wisconsin. I mean, we talk about the differences from the coast to Wisconsin. The impact on our market was just not nearly as significant.
Hey, John, can you share with us, I know BMO is a national lender. How did the Wisconsin portfolio compare to nationwide? Where do you guys have your bigger problems and how does Wisconsin fare?
Yeah, great question, Steve. I think Wisconsin held up really well. I think it's a property type specific comparison, and fortunately we don't have a ton of retail exposure, and our hospitality efforts are really centralized out of our hospitality team in California. So minimal Wisconsin exposure. More broadly, I think BMO really hunkered in last March, April, focused on portfolio management, took on extensive underwriting projects, basically by property type, multifamily, industrial, office, et cetera, and tried to discuss with clients, get our arms around market research and see, where this could go with COVID and how bad could it get? Were we ready for it? And I think largely we probably overshot a little bit in hindsight. It's held up very well. Spent a ton of time evaluating it, but we've been happy with the portfolio performance, and we're probably a little slower coming back to the market in the fourth quarter, and then first quarter 2021. It's really taken off, and new productions really back to 2019, probably surpassing 2019 levels at this point.
Am I clear? Did you guys put like triage teams for different product types, like a hotel triage team and a multifamily, et cetera?
Yeah, exactly. Yeah, exactly, Steve. There were underwriting teams. So I was actually the head of our apartment underwriting team, and there was 5 of us just trying to get our arms around the portfolio and what certain stress, rents, vacancy, that sort of thing would do to the portfolio.
Exactly. And Regina, you were the Chicago bank, headquartered in Chicago anyway. Was there much of a difference between Chicago's approach and your approach, or the experience you guys had, or in your portfolios?
Yeah, I would say our experience is pretty similar to what John stated. Things really, we went into 2020 really strong. And then of course, a lot of deals fell apart. We were really focused on portfolio management, really talking to clients, understanding what was happening in their portfolio. Much more focused on that than doing new deals. Luckily, I would say that the portfolio did a lot better than we maybe anticipated at first, but really similar to all the exercises John just went through.
In terms of pricing, I'm not sure if you guys all experienced the same thing we did, but in our pricing model, our cost of funds went crazy for about a month, where we had deals where you have maybe term sheets out or verbal quotes out, and all of a sudden our cost of funds went up 300-400 basis points for a multi-week period. And we were sweating bullets on that situation, to work through that and keep being reasonable clients, but having to make sure that we don't book a loan at a loss. Did you guys have similar problems with a spike in pricing at any given time last year?
Yeah, I definitely, it was always a point of discussion. We tried to, obviously protect the bank and make sure that we're still getting a spread that makes sense for us, but making sure that the client is happy too. And between the time, where we issue a term sheet and actually lock the rate, we can manage that risk. That definitely, and last year too, we started implementing floors. I think that was pretty common across the board. That has since sort of subsided, and we're back to, I would say, especially it's so competitive right now that spreads are really, there's a lot of compression there. So we're getting pretty aggressive now, but for a moment in time there, yes, there was a lot of uncertainty.
Yeah,
John, you had LIBOR floors too, I think, in your deals, and
we did. Yeah, we did for sure, and that was just scary times in March and April, Steve, with the pricing volatility and some awkward conversations in that environment. Fortunately, I didn't have a ton in the pipeline, just dumb luck at that time, so it wasn't terrible, but definitely saw funds pricing spike March, April, trying to salvage some deals and serve some clients in the meantime. But it was a tough environment. And LIBOR floors, it was an obsession at the time. I remember speaking to a client and they were asking me about the floor before they asked me about the credit spread. And it was kind of like these should go hand in hand. We shouldn't obsess so much about the floor. But that was just the environment. And like Regina said, that's really subsided today. So floors are basically back to zero or maybe a spot rate floor. And banks are trying to get it in the spread from my experience. But yeah, that was wild last March, April for sure.
You know, John, you and I have always talked about this in the past, where, you know, my thing is real estate's on a 10-year cycle. And in 9.5 out of those 10 years, it's a borrower's market. And you have all the banks beating each other up on structure, on pricing, trying to get deals. And then something turns upside down. It was 2008, whether it's COVID, and all of a sudden, for a short period of time, banks have some leverage and they start putting floors in and bigger spreads and tighter cut, you know, more conservative structures. But very quickly, that sort of evaporates and we're back to a normal market where you've got banks fighting each other again. So Adam, what's your read right now? Pretty competitive market out there?
Yes, certainly from a pricing standpoint. One of the things we're always trying to watch out for is that giving away a structure. And we've started to see a little bit more of that. You know, it's interesting. We do business here in Madison. The Madison market is continuously an extra 25 basis points, 30 basis points more aggressive than Milwaukee, even though it seems like we've got the same level of competition. But I don't feel like there are too many people sitting on the sidelines these days.
And Madison's been like that so I can remember. I've been in this market 25 years, and it's been 25 or 30 basis points more aggressive on pricing forever. So just, I think maybe same number of fishermen, smaller pond, and you get you know, more competition. In terms of where you guys are, where you're locating, when you're coming back to the office, John, you built a big new tower. Are you in? Are you out? It's like you're working from home, is what I can tell here.
Yeah, I'm still at home, Steve. We took occupancy in the new space back in May, and I've been there twice. So we certainly have better attendance than I. I've got a 5-month-old at home, so we're planning maybe a little more cautiously than others. But I know some of our commercial commercial bankers have been in for months now and regularly going in. BMO did just roll out a June 1st return to the office. 50% of the time is the expectation. So we're trying to figure that out now, if it's a rotating basis or trying to collaborate and people going in at the same time. We're figuring that out now, but they definitely turn the messaging and want people back in the office to build the culture and all that.
You need that. Regina, how about you guys?
I'm also still at home. We are anticipating, we started a return to work, I think maybe in the fall. And then that sort of subsided pretty quick with cases going back up. And then, you know, now they're saying also June, July, what it looks like, whether it's going to be full-time or on a rotation or part-time, we're not sure yet.
Adam, question for you. I see just office lending. What are you finding in terms of your clients' office buildings, especially suburban office, as these leases are, tenants coming back into space and their leases are maturing? Are they taking less space? Are they taking more space? What are you seeing?
It's a great question. It varies for sure. We just approved a fairly large refinance of an office complex that is pretty much all small tenants, and they have not lost any occupancy over the last 18 months. It's stayed very consistent. We have a couple other office buildings where it's a tenant by floor, and that's where you're seeing more tension there between the landlords and the tenants trying to shrink up that space. Also seeing some interesting discussions about how CAM's getting calculated. So I think they will find other ways to make up the difference if they can, the landlords.
Does anybody have a loan on a building that's got like a WeWorks or one of those WeWorks type entities taking multiple floors? Is anybody monitoring that market at all?
No, we have not, Steve. Been very cautious on the co-working front.
We would be as well.
Yeah, we haven't here in Wisconsin. We probably have some other offices around U.S. Bank, but I just think that's obviously going to be an area that's going to could be hit fairly hard, given people don't want to be that close to each other anymore. But we will see. Elevators, the other thing I've heard of it, like in New York City, we've got a lot of exposure there in office buildings where the number of people allowed per elevator cab is very much limited. And if you've got a 40, 50, 60-story building and you can only fit 2 people in an elevator, that's going to be very problematic when everybody starts coming back to work. So we'll see how that plays out as well.
Everybody's going to get in better shape.
Yeah, right. But let's hit the nitty gritty, because we do 3 different types of lenders: money center bank, regional bank, credit union. Loan to cost. If we have a multifamily deal today, where would you guys typically come in as your max loan to cost? Maybe Adam, you want to start with that?
You know, we don't do multifamily construction right now. We've had a consistent stream of multifamily deals from refinances and purchases. So we've decided to hold off on new construction. But on the commercial construction side, we'll still do up to 90% of cost, not to exceed 75% of appraisal. And that continues to work really well for us. If you're building building to leases, you're typically creating enough value through those leases that the lower equity still results in a good loan to value long term.
Right. Interesting. How about John? How about you on loan to cost?
Yeah, I think we always break it into two buckets. The one, recourse, and the non-recourse. We do quite a bit in the non-recourse space, and I think on the multifamily construction side, where we are very active, that's definitely been back to pre-COVID levels, if not surpassing them. I think we generally, on a non-recourse basis, are 55 to 60. I think we've certainly lost deals in the last month or so at 65% non-recourse. And then on a recourse basis, depending on the sponsor, 70 to 75 would be attainable perhaps on the relationship and right sponsor. But honestly, I feel like leverage is more dictated by the cash flow coverage restraint today,
Sure.
debt yield or DSC with where construction costs have gone, and that has definitely loosened more than pre-COVID. A reflection of interest rates and where those are at today, but we're seeing deals on the multi-construction side, sub 8 debt yields getting done pretty consistently.
Yeah. And then you said you do non-recourse construction loans, or just are those term loans, the non-recourse?
Those are we'll do non-recourse construction.
Okay, just a completion guarantee and carve-outs, and then that's it.
Exactly.
At a much lower leverage level, 50 to 60%.
55, 60. Yep.
60. Yeah. Interesting. Regina, what are you seeing in terms of loan to cost, loan to value?
Similar to John, multifamily with recourse 75 to 80, non-recourse 60, 65. It of course, it depends on the sponsor, their experience, and, property type. If it is like a build to suit, for example, there's a lot more leverage depending on who the tenant is,
Right.
but similar, yes.
And I mean, in terms of debt coverage ratios, do you typically look more at a debt coverage ratio or just straight debt yield? What is it? They're kind of similar, but they're a little different.
Yeah, I mean, our loan policy is a debt service coverage ratio at a stressed, interest rate.
Right.
But internally, we still look at debt yield, because the rates aren't going to be where they are forever. So
I think one other thing we try to look at is what's going to be the situation at lease maturity or at loan maturity, not just looking at the loan on the day of closing, making sure that the structure accounts for that time period.
Sure. Depending how long the lease terms are and whatnot on the rent roll.
Exactly.
Has a big impact. Spreads, I don't want to ask exactly spreads are, but we'll get into issues there. They're probably too close to the home, but spreads going back to where they were in 2019, you think? So COVID's gone by now in terms of spreads, or?
Yeah, it sure feels that way. In the past quarter in particular, it's gotten, depending on the asset class. Again, definitely there are favored asset classes, multifamily, industrial. I'd say life sciences. I feel like I'm missing maybe just MOBs in general are the favorite asset classes, and I'd say those are pretty close, if not back to pre-pandemic levels.
Is anybody lending on hotels today? Any of you guys?
We have looked selectively for strong cross-sold relationships with an opportunity. So very little, but yeah.
Construction or existing?
Existing.
Existing, yeah.
Yeah.
It's not a bad time to do it. You be counter-cyclical.
Yeah, I think it's a yield play too, right? It's with pricing didn't compress so much on those other asset classes. If you can get paid and you like the sponsorship story, it could be compelling.
Have you guys has anybody done a life science deal in Wisconsin? A big one? I haven't heard of one. That's why you mentioned life science. I know we've done them across the country, but I've not heard of one done in Wisconsin at all. Yeah, it's a favored lending type right now. I know that U.S. Bank it is, that's for sure. Anything doing with medical is we consider growth business, and we're all over.
There were a couple of newer deals in Madison that got done. I think some new tenant deals. I think they were actually done as speculative deals on the construction side, and then they landed a life science tenant. So those may be coming to market for new long-term lease or long-term money.
What do you guys see in terms of for retrofitted space for TIs for office buildings? What are they running? North of 50?
Yeah, I mean we used to always use $40 a square foot, but I don't think that makes any sense right now with where construction's going.
Yeah.
Timber prices.
Well, that's a great topic, then, Adam. Why don't you riff on that a little bit in terms of lumber prices, all the raw materials prices are way up. How's that impacting how you guys structure your loans? How do you protect yourself as a construction lender to make sure you don't have cost overruns? How do you look at that today?
Well, in general, I mean, we're still working off a signed budget prior to construction. We're always building primarily to leases. So as long as the leases make sense, and like I said, it's not just on day one. It's gotta make sense in the long run. We want to be at the right dollars per square foot. Really, we want our borrowers to be at the right square foot at the end of the lease maturity. We'd like to be in a position where we can lend back to re-tenant the building and not put ourselves or them at a bad position. So leases have stayed at very high levels, lease rates. So that's covered a majority of the construction costs. And, on the multifamily side, like I said, we're not doing that right now, but that's got to be a little bit more challenging.
Right. Is anybody bumping contingencies now in their construction budgets just to build in contingency for excess, cost increases over the construction period, especially a high-rise deal or something like that can really have a long time period before it delivers?
Yeah, Steve, I think we talk a ton about the construction cost volatility. It feels like that's certainly the top point that our clients talk about as well. And beefing up contingencies for sure. That's something we've talked about. Depending on the nature of the product, what they're building, and the sponsor's experience in it. We may just live with what we've historically done, but yeah, anything high rise or longer lead time with more volatility potentially would warrant wider contingency for sure.
But just go ahead.
I was going to say, I would agree. There's a lot more, either building in the contingency or really understanding when the client is ordering their materials, when they're coming in, if the contract is in place. And I think the other thing that we're seeing, and maybe I'll get to it, but due to these construction prices for multifamily or other developments, I guess outside of office, it's taking more buy-in from the municipalities too to make some of these deals work. So I think that's been a big change that we've seen recently.
That raises an issue as well, Regina, in terms of municipalities and TIF funding. When you get a big TIF into a deal, do you view that as equity? Do you view that as a quasi-equity? Would you deal just a great big TIF and very little borrower equity? How do you view that?
I mean, we like to see borrower equity in the deal. You know, it depends. It depends. It depends on the deal, the amount of the TIF, you know, how it's paid out, whether they're going to capitalize on it, or, you know, if it's like a pay-as-you-go type of situation. So, but in general, you know, I would say deals, the conversation is longer, you know, from the time that the borrower comes to us and says, hey, we're thinking about doing X, Y, and Z, to the time that they've actually negotiated with the municipality in a meaningful manner that makes sense for the deal.
Right.
I know.
Go ahead.
I've seen an increase in the requests for financing the TIFs. So I have a feeling that most lenders are not viewing the pay-as-you-go TIF really as the equity. It's the front-loaded TIF obviously is, but I think we're going to see that for at least the next couple of years.
Adam, question for you, just because I see Landmark building branches all over the place, these big attractive branches. Tell us about your expansion. Are you involved much in the whole retail expansion network, and they built a new headquarters building? You guys are doing a lot.
Yeah, maybe it's counterintuitive, but we're still seeing that 86% of new deposit openings are based off of whether there's a local branch. And as a credit union, I think there's maybe even a little more importance. Our members tend to be a little bit older, a little less tech intuitive, although that's changing rapidly. The North Shore area where we've added Glendale and Mequon was an area that really lacked any presence by Landmark. So that's a major win. Waukesha, then, you know, now we're looking at Fox Valley and Madison and trying to decide how we're going to enter those markets. I do sit on the site selection panel, and so that's been interesting. I think right now we're in let's say a COVID pause, trying to decide what our next moves will be. Definitely focusing more on the digital right now than the new branches.
Based on your licensing and whatnot, can you go out of state or not? Can you open branches elsewhere?
No, when you acquire a credit union, you can absorb their charter. So we had acquired a credit union, I think it was down in Beloit. They gave us Lake and McHenry counties in Illinois, but I don't see us expanding branch-wise out of state. I think a digital approach is probably the best bet.
Maybe we can go around the horn, all three of you, in terms of where will you lend? You've got a developer, lives in Milwaukee, wants to build an apartment project in Texas or Carolinas or wherever. What's your market footprint for where the geography of the actual property itself? Maybe Adam, you want to start?
Sure, I'm sure I'm the most restrictive on that. Credit unions are chartered by county in the state of Wisconsin, so that's basically for us. It's Lambeau down to Miller Park and over to Camp Randall. Anything in between there we can lend on, and then if you're a sponsor, a majority sponsor of a deal, then we can go beyond the market. And so we do quite a bit up in the Wausau Plover area. We can go up to the Minneapolis area. We've started doing some deals further south in Illinois and northern Iowa, but that's about as far as we'd want to go. We want to make sure we understand those markets extremely well.
So you can follow a sponsor to the nearby Minnesota, Illinois, but the sponsor's got to be here. You can't deal with an Illinois-based client. Then is that what you're saying?
Unless they're based out of Lake or McHenry counties, correct?
Okay. And Regina, how about you? Where will you lend?
So our footprint is considered Illinois and all of its contiguous states. That was expanded a little bit, you know, to Michigan, Minnesota, you know, Kentucky. So, you know, it would be nice. What we would like to see, I would say, is the opportunity for a relationship with a client. So if they live in an area where we have branches, which of course is Illinois and Wisconsin, we'll sort of follow them out, especially if it's not our first deal with them. You know, if it's, for example, a sponsor out of New York buying a property here in Milwaukee, that's probably not something that we would look at unless it's really a compelling deal or story or something like that. But we like to primarily stay in the general Midwest area.
Great. And John, I know you cover Wisconsin and Texas. That's where the sponsors are. Is that correct? And you'll go anywhere, I assume, in the country with them?
Yeah, exactly right. It's a sponsorship model. You know, personally, I'm covering Texas, Wisconsin-based sponsors and follow them anywhere in the continental United States. So lose out on Hawaii and Alaska, but definitely a sponsorship model. Our retail presence is a little spotty, that legacy M&I presence, but certainly there's different CRA and community reinvestment considerations within our footprint that make us want to get a little more aggressive in footprint, but can follow sponsors nationally.
Steve, can I add one thing real quick? Just want to clarify. You know, we will finance sponsors from out of state who are buying. That's actually been something that's picked up for us, as long as the property is in our chartered areas.
How do you source that business now? Are you calling out of state, or it just kind of falls into that?
You know, part of it came out of attending events, real estate events at a national level. Part of it comes from broker activity. And part of it's just straight referrals. So
you do broker deals then, mortgage broker originated deals, a lot of those, or is that what percentage of business would be broker generated?
I wouldn't say it's a lot. It's increased more in the last year. I think part of that is as the insurance companies and CMBS markets got quirky and dropped some of the deals that they were midway through. That gave us an opportunity to step in, and then those deals have led to additional deals. We've actually had out-of-state sponsors that are referring other out-of-state sponsors to us as they're looking in this market. And we're obviously becoming a much more attractive market for national level sponsors.
Right. Well, I know one thing, sort of a blast from the past. I don't think this is impactful anymore, but HVCRE was a big deal at one point in time. I think the rules there have been modified to a certain extent. Have you guys seen any change in your structuring your deals in response to the HVCRE?
I would say we haven't seen a change. It's something we're cognizant of and mention and, you know, understand, but no, I wouldn't say we've seen a change.
I assume they're structured, but they're not HVCRE, I'm assuming, correct?
Right.
Yeah. John, are you going to say something?
I was just going to echo what Regina said. Thankfully, the HVCRE craze seems to have subsided a little bit.
So good we have you on there, John, because the next issue is for you, I think, and that is the next craze, which is LIBOR going away and banks transferring to SOFR. Can you tell our audience something about that, what they should expect? Yeah,
well, you know, for the benefit of the audience, I didn't realize I was nominating myself to be the point person on LIBOR replacement, which is not where I want to be. It is, I think, yeah, Steve, I think it's later this year into next. It's definitely a hot button topic. You know, something I shared with the panelists is there's at least some better standardization, it seems, in loan docs. And I forgot the governing body of attorneys on syndicated docs had a meaningful role in this, but putting out some hardwire language is what we refer to it as, and that seemed to have helped. We don't really negotiate that language. It kind of is what it is, and it's basically punting for the most part, but that's definitely something we're working in. All amendments, certainly any new money, anytime we're touching documents, this hardwire language is likely to come up.
Well, we're at our 40-minute mark. We're open for questions. Any last comments anybody wants to make before we open to questions for Tracy? Tracy, you got it. What do you have for our panel?
Wow, that was tremendous. Thank you guys so much. just want to let everybody else know that if you want to ask a question, use the question box. I know we have a few in the queue here, also chat function, or you can send me a text message. So here's the first one that came from the audience. What have you seen happen to DSCR over the last 12 months by asset class? Not sure who's best qualified to take that one.
I'll jump in. We haven't seen a significant drop in debt service coverage, certainly in the multifamily market. I think there's only been a 1.2 or 2% decrease in occupancy rates, but with rental rates rising, that's pretty much covering that. I think as a lender, you're looking at it more, we're at a very low point in interest rates. So instead of saying a 120 debt service coverage is the norm, you're trying to get to that 125 to 135 on your deals, because at 5 or 6%, which we're more likely to be at in the next 5 years than we have in a long time, you want to make sure it's still working. Because I don't know how much rent increase we still have left to go. Wisconsin took a long time to get the increases that we've gotten this far. And certainly markets like the Fox Valley, they tend to increase very slowly. So making sure that you're accounting for that rent sensitivity in the future.
Well, and we've got so many apartments coming online still, you know, and a lot of market rate deals. Do you have any input or thoughts on some of the conversation about workforce housing, and you know, does that come up as you're structuring deals for apartments or multifamily? I don't know if that would be Adam or anyone else who does multifamily.
Yeah, I'll start there, Tracy. I think the affordable housing, just in general, more broadly, affordable housing is a big push for us. And I think that ties back to the CRA credit that I mentioned earlier. It's a motivator in a deal. Without question, in this market, we will get very aggressive to win CRA credit and work towards affordable housing requirements in the community.
Yeah, and that goes back to kind of that conversation that you started down with the TIF and, you know, working within these different communities. They're not all communities are the same, right? There's so many different, you know, different ways to look at it. Anyone else have anything to add on the debt service coverage ratio? Any other asset classes to touch on outside of multifamily?
I think when we underwrite, what's happened is typically our debt coverage ratio hasn't changed. It's typically 1.25 on most deals, but the constant that we use to apply against that has changed because interest rates have gone down. They've stayed down for a long period of time. So I think a lot of banks have over time, that's really what changes, not so much the debt coverage ratio, but the debt yield goes down because the constant goes down because your loan sizing interest rate has gone down over the last, say 2 years or so, especially over the last maybe 6-8 months. Ours has gone down quite a bit, especially we love term loans because they fund and we do a lot of construction lending as well. But we also are probably more interested today in putting term loans on the books, and then we've gotten pretty aggressive on loan sizing and debt coverage ratios. Or not so much debt coverage ratios, but the debt yield on funded debt today.
So what is that going to mean for deals in the future? I mean, it sounds like there are some changes and some restrictions, you know, right now. So what does that look like in 18 months or 3 years? And even if that has to do with a rise in interest rates, that is inevitable, right? What goes down must go up.
Well, I think what you're going to see is the intensity of the market right now. I mean, there's so much money chasing deals. So as prices keep increasing, I think you're just going to run into some situations where people aren't willing to go to 80% loan to value. It's going to be a 75% loan to value. The prices of the properties are somewhat independent of cash flow at times.
Got it. Sorry, I was dealing with a power issue here. All right, we'll move on to the next question. COVID aside, with interest rates so low, what debt yields are lenders seeing for new multifamily projects or even stabilized multifamily projects in general? John mentioned sub 8% yield deals that they lost at BMO on new construction projects. 5 years ago, an 8% debt yield deal on new construction project would get left out of committee and never get done. What's going on here?
Yeah, great question, Rory. I would say that 8% debt yield, I mean, that probably got laughed out last year even, or pre-pandemic. So I think there's a number of things going on, and I agree wholeheartedly with what Steve said earlier about just funded debt. Certainly at BMO, and I think banks in general, we've seen a lot of payoffs, especially through the course of the pandemic, and wanting to replace balances and get good funded debt has made it more competitive. And then you layer in interest rates and how low they are, and where the agencies are, in particular on the multifamily side. When agencies are placing sub 7 debt yields, you know, and a 7.8, a 7.9 debt yield on the senior, for a bank seems like it's a decent debt yield, or doable at least. So it's definitely tightened. How low does it go? You know, market too frothy. It's legit concerns, Rory. I agree. We kind of talk about that as well. You try to pick up recourse in a case like where you got a sub 8 debt yield if you can, and have other avenues of repayment if needed. But also bear in mind, it could be a merchant developer that's building and selling in 2.5 years. So you're not going out 10, 20-year risk at the same time. So kind of dumped a lot there, but it's a great question.
I want to kind of add on, just from a big picture standpoint, I want to ask about the regulatory environment. You know, we talked a little bit earlier about LIBOR and SOFR, but you know, what are some of the other things that are going on in the regulatory environment that are going to impact banking or lending for commercial real estate projects in the future, whether it's, you know, the concerns around 1031 exchange or accounting practices? Maybe go around the horn and say what's kind of top of mind for you. Start with Steve.
Well, I think for us during the COVID crisis, I think we were actually a little pleased with the way the regulators handled it, in that in 2008, they came down with a heavy hand, with a sledgehammer, just pounding the banks, forcing a lot of write-downs that ultimately got, you know, were reversed. In this case, this time around, I didn't think they were nearly as heavy-handed. They realized what was driving the problem. It wasn't a supply or a demand issue. It's just strictly a health issue that would hopefully, you know, correct itself, which it did. So from that perspective, I think they've been more reasonable than they have been in the past. And sometimes when they come out too heavy-handed, they do more harm than good. So I was pleased with how they handled this pandemic.
John, would you agree with that?
Yeah, totally. It was nice that the banking sector wasn't kind of the cause of the problem, and so the regulation was not really an issue. And I don't know if I'd have anything else to point to, Tracy, to be honest, with concerning regulation today. Nothing jumps out at me.
I mean, while the, you know, regulatory environment you know, was different than it was, let's just say in 2008 or 2007, 8. I mean, there was a fair amount of pressure or, you know, involvement from the banking sector. Think about the PPP loans. Think about, you know, what the government was asking of these banks. I mean, is that have any impact on the way that you have a relationship with your customers or clients, or the way that you look at how you do deals right now, or even in the next 18 months? No?
I would say, I mean, the banks obviously, you know, First Midwest there was a ton of energy put into PPP. But no, I don't think it had an impact on how, you know, how we view deals or our clients. for real estate deals, you know, at least that way. I think we look at real estate sort of the same as we have, and PPP was a nice addition for some people. And I think it was an opportunity for banks to maybe grow a relationship or to start a relationship with a firm that, you know, they previously hadn't worked with. But I don't think it will have a long-term impact on the overall, you know, way we do business or how we do business.
And what has impacted us initially is that our bank, and I think most banks, we're absolutely flush with cash. Got more cash than we've ever seen. Deposits are all-time high. We're not even looking for new deposits. Loan to deposit ratio is as low as it's been in a long time, just because, well, PPP money, but you know, it's being parked with the banks right now.
So is there?
The only thing I'd say is just that getting through that first 3 months of COVID with the regulators saying, do what you need to work with your members, was a huge benefit for Wisconsin real estate owners. I mean, if you think about the retail center that's got 3 restaurants and a financial institution, all 4 of them were closed. Even if they were considered essential, they certainly weren't operating at the same level. So the PPP dollars or whatever other assistance they received got you through the 3 hardest months of last year. And in most cases, people were able to modify leases, do the work necessary to get back to getting the full cash flow they're supposed to get as the landlord, and the tenant being able to maintain their space.
Great, keeping people connected, you know, to their real estate. I want to ask to see if you guys have a perspective on, you know, just the amount of cash in, you know, in the market. If there are any concerns of a looming bubble. I mean, I look at housing prices, and I know this is more of a residential question, but it speaks to the broader issue about money in the market. Housing prices are getting blown through the roof. So what is the future implication of, you know, what people are borrowing right now, and what that does to the cost of all real estate moving forward? What are the conversations like within your teams? Any impact there?
We don't do a lot of, we've got a separate division out of California that deals with the major national home builders. We don't do a lot of home builder, we don't do any home builder lending, really, or very little out of our office. But I just think that from my kids' perspective, they're all, you know, looking at prices going crazy, but rates are really low. And do you jump in? Do you not jump in? It's a tough decision for a young person to make right now. That's, you know, starting a family, because prices are, you know, off the charts, and, you know, the people getting way above their list price with multiple bidders, which makes the prices unattractive, but their interest rates are so low. You know, I don't see it changing unless, you know, cost of construction comes down, because the difference between a cost of a existing home, for instance, in Mequon, and a new construction was huge a year ago. Now it's narrowed a bit because the existing home price went a bit up, but until the cost of construction potentially comes down, I think you're going to see a tight market with very high residential prices.
Yeah, I think on the commercial side, what you're seeing is that the national players definitely started coming in knowing that they had to put more money down, because they were willing to pay premiums for the right properties. I don't know how long that'll last. That's more a competitive issue on the financing side typically than it is a decision that a REIT wants to make. But, you know, if you're talking about a local Wisconsin buyer, they still want 80%, but there may be pushback at some point to try and lower the initial loan to value.
All right, I got 2 more questions for you. These are pretty quick. You talked a lot about interest rates being historically low. Any kind of thoughts around when we might see some movement there? I've heard as early as next quarter. You hear things that are pushing it out for 6, 12 months. Anything?
I don't pretend to pick a date there, Tracy. I do think it's going to creep up slowly. And I've heard the rumors about, you know, next quarter, some first movement there, but I think it's going to be a slow, I mean, certainly on the the 30-day rates. I'm talking about the longer term rates have already moved substantively, but we'll see. I think it'll be a slow rise when it starts.
Great. Regina, you had mentioned earlier that just recently First Midwest had acquired Park Bank. Do you think we're going to see any more consolidation in the banking world? This has certainly been a positive environment for many in banking. I know Adam said this is one of your best years ever. What are you kind of hearing, seeing, whether it's national getting bigger or local branches breaking off? Any thoughts on that?
I mean, I think it will continue. We'll continue to see a lot of M&A activity with banks. I think a lot of it is just a function of costs of doing business and, dealing with the regulators and all of that, where, sometimes it just doesn't make sense. And then too, to be competitive and win the deals, the smaller banks, I would say you need to have a niche, right? Like Landmark, they're not that small. I mean, they can go to a 10, $15 million loan amount, but the really small banks, I just don't know that they'll be able to compete long term. So yes, I definitely I definitely think it will continue.
The technology costs are so expensive, and with the phone-based banking and internet banking, they have the capacity in-house to be able to stay on top of all that. Costs a ton of money, and the smaller banks are having a hard time keeping up. There are some sort of consortiums of banks that work together to have a tech process or a tech function that has some economy of scale to it, but it's hard for a small bank to be technologically proficient today, and you can't get younger depositors unless you're pretty high tech.
All right, final question. And this is a quick one. What's the one economic indicator that you are watching, whether it's you've always watched or you're watching right now and paying the closest attention to kind of show us where the future's going in finance?
It's like job growth. Job growth is something we follow, just asset project specific. Job growth in the area is a demand driver for so much in real estate. That's certainly up there towards the top of the list.
Great. Steve?
I would say population growth, in addition to job growth, the population growth. Wisconsin has always been a slow grower. I believe the latest numbers were some of our best growth numbers in a couple decades. So that's great. But the other thing is the interest rates. I mean, John made a comment about where they're going. And I couldn't disagree. And at the same time, I just heard, we're going to be at 2% by the end of the year on the 10-year. So I really don't know. We've been betting that they're going to go up for so long, and they have not done it. So we've been betting wrong for a long time as bankers.
Steve, how about you?
It's just a price earnings ratio on the stock market. I mean, now it's like 37, 38, which is double what it normally is. Obviously, with rates so low, where else are you going to put your money? You get a better yield, still get a better yield in the stock market. But that's something that I think, I'm not sure if that's sustainable. So I watch that. Great.
Regina, we'll end with you.
I don't have anything original to say.
That's all right. I think we had some great answers. Really appreciate all your time. And Steve, I thank you so much for coordinating all this and bringing these tremendous insights to the table and getting this phenomenal crew together. I know you guys will continue to be resources for all of our members, for our industry. Thank you for everything that you do. Thank you to Adam Newman and Landmark for being the presenting sponsor for our Lunch and Learn series. Again, Regina, Steve, John, and Adam, thank you so much for your time. And thanks everyone for being with us today. We will wrap this up into a video and share it with all of you along with the contact information of our presenters. Have a great day, everyone.
Thanks, Tracy.